Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show, we do a deep dive into different industries using weekly charts to see what is happening on a long time frame basis. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on gregschnell.com as well as stockcharts.com. So I think the main problem with this bull market is it is uphill all the way, and we got a certain number of hurdles to start jumping through. So today we're going to discuss the deep dive and where I think we are in the move. So the agenda, the global breakdown continues. There's a proliferation of fear, I would say, in the markets in the regions that have seen COVID-19, and other places. There's just this almost immunity or this belief that it's just overblown or whatever. It seems to accelerate once it's in everybody's backyard. So watching that closely, because I think that changes opinion quickly. Now I think the governments are fully on board with some sort of a cycle that's coming to us, that they're going to try and figure out how to keep small business working. And so as an example, Google announced last night that they're going to keep 100,000 people home and allow them to work from home. The real problem with that is everybody who owns a business in that building still has their lease to pay, but nobody's coming for coffee or lunch or whatever. So throughout, Amazon's doing this, Microsoft's doing this, Apple's doing this. A lot of the corporations, a lot of the banks are doing it already. So you've got this situation where small businesses kind of have a zone of business around them, and all of a sudden that whole thing drops. So it's not just the large companies that we're focused on here. I think the small companies that might not be public are the ones that are going to be under pressure. And so somehow this government jumpstart will need to figure out a way to help these people just stay afloat from the start of this to the median end of this, and somewhere in there try and make sure that all of these businesses don't have to declare bankruptcy because they can't pay their rent and that kind of thing. So anyway, that government jumpstart should be coming in the next few days or week. I don't. That'll obviously give some sort of a surge to the market, but I think the real question is what's going on behind the scene. And so we're going to go look at consumer discretionary. We're going to focus on that. I will say that there's a few names in the healthcare space. I think hospitals are going to end up being one of the focal points here, and healthcare providers could be one of the biggest beneficiaries. So if all of these charts start to turn up at the same time, I think that's an important place to look. Anyway, let's check the charts. So starting off, I wrote this article late yesterday, and I just want to make sure that people see what's going on here. So first of all, as the number of cases hit over 1,000 in the US this morning, and they were 800 yesterday when I wrote this article, it is changing quite quickly. Lots of the universities are closing dorms, and businesses are emptying buildings. So when we look at some of these other markets, Japan still plans to hold the Summer Olympics, and we'll see how that goes. But here's the uptrend for Japan, and we see that the market here was at 20.7, 20,700 back in 2015. And then we've built a triple top here, and now all of a sudden we've rolled down and we're back below this 21,000 level. Now the next point obviously is if it drops below the 2018 low, we're down to 3-year lows very quickly. So that is one of the charts that we need to be watching. And again, Japan is ultra sensitive. They had slowing growth before this event happened, so we'll see how this works out. Rolling into South Korea, the chart is approaching an 8-year trend line, and this one needs to hold right here for obvious reasons, and it wouldn't take much to get to 3-year lows or 5-year lows or 8-year lows based on how fast we fell from 2,200 to 2,000. This 10% move down in 1 week, if we were to do that again, obviously that would take out some of these prior lows. But here's Italy, the country with the whole country on lockdown. And looking at this chart, it's kind of telling us what we're expecting, right? These trends are breaking worldwide, new 3-year lows here. This is England, and one of the issues for England, Heathrow is, if you've ever been to the Heathrow airport, there are 747s parked everywhere, and they come in from all over the place. It's a very international hub. And on that particular scope, what you see here is this country's already at 3-year lows, going on 4-year lows, and they were, of course, they have the Brexit that exiting the EU that triggers right around the end of January. So with that, we've got some additional things going on there. But one of the things I'm focused on is the fact that it's such an international destination. You've got the whole financial center there for people doing deals. You've also got the former linkage to the British colony of Hong Kong. So there's lots of Asian influence or relationships that were set up over long periods of time. So with all of that going on in the background, London seems to be really under pressure. And again, it wouldn't take much to get, down to 8-year lows here. It would be another week of what we've just seen. This is a growth rate of the pandemic, or the, I don't want to call it a pandemic because I don't think they've officially announced it as that, but the COVID-19 growth in Europe. And these are days, and this is very, very quick. And the yellow here is Italy. But obviously, if all of these columns, colors start to grow like Italy's growth rate has, I think that sets us up for this situation where we're, quickly overwhelmed. And it's the hospital infrastructure that gets overwhelmed, just the ability to care for all of these people at the same time. So, looking at my Schnell strength indicator, and this is just a private indicator I've created, what it does is it just keeps track of the momentum of the market. And it had been falling anyway as we headed into the new year. We're sitting down here at 0. And at this point, there is no reason to jump back into the market. We at least want this to start getting up above 10 or 15% of things with improving momentum. And we don't have that yet. So anyway, stay careful on this because again, we don't get to see the whole picture, and we don't need to, I'll call it create fear, but we need to be cognizant of what happened in periods where the market is moving down quickly. And this move down was one of the fastest moves down, 20% we've seen in a very long time, if ever. And so you get we had the one-day drop in 1987, but with a kind of a systemic move down. The point I want to emphasize is the first few weeks, and in this case, we've got two problems. We've got the COVID-19 and we've got the price of oil that collapsed. But in there, if you remember back in 2008, it was a bank financial crisis, but it was car companies that needed to be bailed out, and it was auto workers that needed to be protected and all that kind of thing. So it may happen over on one side, and then the problem is that over time it went wider. It went into a much bigger portion of the economy. So as the economy changes here, I think we want to be very astute and not forget that down markets, all of a sudden other problems start to come to the forefront. So companies that were trying to get their footing struggle to get their footing. And, if we just go look at the car companies, and maybe I'll just go grab this particular list here. Doesn't matter any one of these, but what I want to do is just go to the bottom here. I've got kind of the car companies laid out right here. And in here, you can see this is Ford. And Ford was $9, early February, and it is now $6. So it's down 30%. But you look at the stress that these companies are under, and we can unwind the tape here and go back to see how they looked. Ford was one of the ones that didn't need assistance during the 2008 period. But it literally started to fall from $5 and went down to 68 cents is kind of the way it ended up. You just see this big collapse, and we made it all the way back up to $13, but we've had a series of lower highs for almost 5 years, and now this is clearly breaking down to new 6 or 7 year lows. So you don't know if this is going to end up, if Ford needs capital or how they end up doing, but obviously this is a big deal to start dropping down to this level. So here's $6 back in 2012, $6.13 in 2011, and we are $6.02 here. So we're below the price back in 2012. So we're at 10-year lows. With that, when you go through these car companies, I think the important thing is not to assume that that just because you're in an industry that isn't whatever, the cruise ships or whatever, that the companies you're holding are going to be okay. And the main reason for me mentioning this is a lot of people just think, okay, well, my company didn't get hit. And the one thing I would use the words with is yet. So as soon as people start to see consumer demand fall off, these consumer discretionary companies are going to have more difficulty just getting people in their stores. So here's GM, $35 to $24, so a 30% haircut. And at least it's trading up off its lows, but again, it's down at 3-year lows. And if we go into, here's Honda Motor, and very close to new 5-year lows on that stock. These are a couple of Canadian names. This one just broke down to new 5-year lows. Linamar and Magna International, big company in Canada, is down to 2.5-year lows. Martin Ray, here's Nissan. This chart's been, I missed Nissan somehow. There we go, Nissan Motors. This chart's been leaking oil for a while. 2019 in February, it was at 1739. It's now at 7. So this is a 60% haircut, and you can just see the rate of change here is picking up. Lots of problems here. And again, that company's got the whole Carl Ghosn thing going on with their mix with Renault in France and with Japan. So there's a lot of issues in there. And then we got Ferrari. It made new 52-week lows this week. Toyota Motors still trying to hold this 4-year uptrend. That's been one of the more solid names in the car space, and it's threatening this big long-term uptrend right now. And here's Tesla. It's actually performed pretty well, I think. I realize it's $400 off the highs, but my point would be, from a parabolic move perspective, some people are trying to hold it here. Just want to mention that as all of the car companies start to struggle, if all of a sudden sales start to get hit on Tesla too, that you're going to end up seeing these car companies move lower. So here's Tata Motors. And what we see on this one is breaking to new 5-year lows. Again, the point is what happens in the bear market isn't just what you see the first 2 weeks. It's what happens, and bear markets are defined by stocks dropping 20%. So we've already done that. So when we start to move down into this sort of environment, what happens is there's an example of a company called Tellurium, and one of the major principals of the company owned stock, and he put his stock up as collateral. And then when the stock goes below a certain price, he either has to come up with more collateral or sell stock to give the bank back their money. So all of a sudden, this stock's been holding $6, and it drops down, and now it's $1. And so when you see these moves from $6 to $1 in a few weeks, all of a sudden these stocks are really breaking down. And we just saw Occidental go through a big merger with Anadarko for $37 billion. And here all of a sudden you see this big move down. Now Warren Buffett put in some money to try and hold this or to get the deal done. Now here all of a sudden what was a $45 stock is a $15 stock, and so 70% off. And overwhelming debt with low revenue. So the picture changes as it expands. And I think one of the things I want to point out today is there's no rush to buy when we're seeing big downtrends like this. We have literally had the first thump, and we need to kind of, if you imagine a basketball where you dribble down and then each bounce is smaller and smaller and smaller, and you're not sure where the floor is. And one of the Goldman Sachs guys on this morning, David Costin, just suggested that he could see prices move down another 15% from here. And a 30% pullback is kind of a general long-term recession sort of level. So we're going to take a quick break. We're going to talk about Dave Landry's show right away. And when we come back, I want to jump into some of the healthcare names and some of the consumer discretionary names. So stay with me. Thanks. Okay, back with consumer discretionary. And one of the things that the internet has created is the ability to sell online. And so when people don't go shopping in stores, it used to be critical. That used to be a big deal. Now they can buy it online and it can show up in front of their door, sometimes the same day or within a few days. So we don't have the same pressure on the actual brand names if people need something. But that walk through shopping where they saw something that all of a sudden caught their eye and they bought pretty much disappears. They have to be sitting on a website waiting and going through article after article and all of a sudden find something that appeals to them. So here's Nike, and what we see on this particular chart is just a big uptrend that's been going on for a couple of years. And now I would say, at this point, we've broken it. Doesn't mean that, the whole stock is going to break down or whatever. All of these things are still above their 2018 lows. But as consumers start to recoil, then this area comes under pressure. So let's just go look at the whole list. And currently I have it sorted based on what was strong, just I think around the end of the year. So we're going to scroll to the bottom of this page. And by the way, to do that function and the right arrow key will get you down here. And what we want to do is we want to remove the numbers. So these numbers in the front that are controlling the order. So let's remove the numbers from here. And once they come off, now what we want to do is we want to go back into summary mode. In edit mode, there's no other fields here, so we can't use it to sort. So what we want to do is go to summary mode, and we want to say, let's go see over the last week. Let's go see what has fallen the least, and we'll put that at the top of the list. And perhaps we can work through the stocks that have held up the best rather than starting with the worst, and or we could quickly go down there to check out the other ones too. But now what we want to do is we can either sort it like this, or we can go by industry group and then just look through and see what's being decimated. So the way we would do that is we've picked this first, now select this second. And when we do that, it's going to create lists for us. We want the sort order to be the other way. So now I'm going to try this again. I didn't quite get it the way I want. Anyway, this will work for us. The big issue that I want to do is go through and see what types of industries are having the most trouble in consumer discretionary, and at least be aware of that, and then think about the potential for where opportunities might be as we come out of the situation we're currently in and start to work our way higher. So with that, the way to do that is to scroll all the way down to the bottom. Again, a function and a right arrow key will take you to the bottom and hit number in sorted order. And by doing that, we're going to add the numbers in front of all of these ticker symbols. So now we've got them sorted by apparel retailer, and we have them in the rate of change order that they were in. So let's just go quickly and just look at them in a 10 per page fashion. And what we're looking for here, so Burlington stores is still holding up the best, I guess. So maybe we did okay. Just there was nothing green at the top there. It screwed me up. Here's TJX, and you can see that it's starting to break its 2019 trend line. So that's the good news. In relative strength performance, it's actually held up better than the S&P 500. So people are liking that TJX price point. And here's Ross Stores. This one's clearly broken a 3-year uptrend. So it just suggests to me that it's not holding up as well, but it is at least doing better than a lot of the other retailers. Here's Cato. This one pulled down quite quickly and bounced up this week. Shoe Carnival looks like people are going shoeless. Here's Zumiez breaking down. L Brands. This one recently came into the news with a bit of a pop, and now it's actually holding in this area quite nicely. I guess it's still down 20%, 25 to 20, but watching it closely in here, and perhaps it can bounce out of here, but it seems too early to buy any of these names. Caleres, this one has clearly gone hunting. Abercrombie and Fitch breaking out to new 2-year lows. So this whole area is, and again, lower momentum on each one of these waves, and all of a sudden we get big trouble and these things really start to break down. So this one was 16 down to 10 in just a few weeks. and multiple year lows. Again, it was back in early 2019, it made its highs. So far, we're not changing that trend. Express was starting to perk up here towards the end of the year. It quickly lost all of that perk up. So from $6 back to just a little over 2. Here's Buckle, and we could just see these stocks are starting to move away quickly. Now, what I wanted to show you from summary mode, when we go back here, so we can look by retailers, and again, we've got it set for, let's set it for 1 week, just to see what's holding up here. In a few days, we'll be able to use the 1 month setting, but you can just see auto parts have been one of the areas that have tried to hold up a little bit better. O'Reilly, where's O'Reilly? For some reason, I don't see it on this list. Anyway, O'Reilly's been one of the better performers holding up in here. This whole area, obviously you want to stay with the winners and try and avoid these ones that are really pulled down hard. They're the ones that I think, are getting early order notifications that are being canceled, or their manufacturing supply chain is disrupted and they can't deliver. Lots of issues. We just went through some of the car companies, and again, not much going well for those guys. Looking through the broadline retailers, I don't think any of us are expecting them to be up, but Target is holding up okay. VIP Shop has done unbelievable, up 25% this week. And then when we look, I know Walmart's been trying to hold in there as well. But some of these other names like Macy's down 25% this week. That's kind of significant. And then when we look going through these other businesses, here's business training agencies, and they're down anywhere from 5 to 20% this week. Clothing and accessories, obviously, if people stop shopping, that's a pretty hard hit on them. And we saw that in that first list. Apparel's up at the top. Using durable household products, these names might or might not hold up, but they look just as vulnerable as the rest to me. So here's iRobot. It's been a weak stock to begin with, and all of a sudden it's down another 15% again this week, and we're still midweek. Looking at some of the footwear companies, Steve Madden is holding up a little bit better, but again, down 10% this week. And I know Monday was a hard day. I'm just saying, looking for opportunities, they don't seem to be here. And when we get down into this gambling space, Vegas is still there, but it might be empty, right? So you're looking at this whole area really hard hit, and perhaps when we start to see something, maybe Macau starts to pick up first, because that was one of the first areas to get hit. But just when we look through these charts, like look at that Las Vegas Sands, it went from 70 to 50. That's a pretty hard hit. Melco Resorts breaking down. Caesars Entertainment, all of these stocks have just been smoked. And again, if people aren't going to show up, it's pretty hard. There's a little bit of online gaming, but their big revenues is the hotels and the people in the restaurants and stuff. So when Vegas empties out, this is hard on that particular sector. Home construction, everybody talked about it, was going to do really well with the low interest rate environments. This week down 15% to down 30%. One of the hardest concepts to grasp is when everything starts to drop, correlation turns to 1. So what was, these were pretty nice charts. Quickly went from 45 to 37. TriPoint Homes 18 to 14. These things are dropping just as quick as retailers or gambling or whatever. All of the names are struggling. So try and be aware of that as you don't make assumptions that companies, just because they haven't been hit yet or were star performers before, will be able to turn the corner quickly. Hotels, obviously, really tough on this whole group. So here's Hilton down 24%. Again, these are all this week. Some of these other names, recreational products, again, if you're not going to if you're not going to theme parks and you're not going to, your income is starting to look threatened because you might not have a job, all of these names are going to start to take a hit. So here's Nautilus down 40%. I might have thought that they would get more orders for home equipment, but these are really big pullbacks. And I think as summer is coming here, you'd think areas like the boats might have some sort of upbeat look. No, they went from 50 to 30 already, and we're just a few weeks into this. Recreational services. Here's your movie theaters and stuff. Madison Square Gardens. That chart's just been hit by $100 drop, 30% or whatever in a few weeks. It's the rate of change that makes it so difficult for these companies. And uh, I know I'm almost surprised at the resilience of the American consumer to go out dining. Like in Italy, the restaurants have been forced to close at 6 o'clock. I just don't know if that's possible in the American economy. But you look at some of these names here; these are down 40% again this week, and that was after already having big pullbacks. So here's Jack in the Box, just to pick one. That was a $90 stock. It's 50. Anyway, special consumer services. True Car or whatever that could help. It's only down 10% compared to those other ones just up there at 50% or 45%. But I think, that chart's been in a downtrend. It's not really the one you want to jump on anyway. Here's a whole area, specialty retailers that have held up. And here we go, O'Reilly Automotive and AutoZone holding up in this area. And then GameStop trying to bounce off the lows. I guess people staying home gaming. Dollar Tree buying lower cost goods. BJ's Wholesale, same thing. Dollar General. So all of these names are trying to hold up. Looking at, here's Penske Auto Group, car sales. I mean, that's a 20% haircut, down 10% this week. These names are really under pressure. And I can see I'm not going to get enough time to get into healthcare. But the point I want to make is go through and look and see if there's any areas in here. And so far, the only green area we've got is some of these specialty retailers. But I wouldn't, just because something has a big dividend all of a sudden or whatever, I don't think there's any rush here. We still have to wait for that graph that I showed, this graph here. If this is still going to be accelerating in the US, it's much different time frame, and when we compress the way people normally live, it really does change consumer cyclicals or consumer behaviors quickly. So just because some of these names aren't in the front yet doesn't mean that they won't be there very quickly. And obviously the travel names have been hit hard. TripAdvisor down 46%. The car rental companies, Hertz and Avis Budget, down 30%. Again, that's this week. So you're seeing these huge numbers. Hertz was $20 here just before, the mid-February, and all of a sudden it's under 8. That's a move, 60, 70% or whatever. And here's Sabre. I think that's the airline system. Make My Trip as a travel company out of India. All of these are getting hit hard, and I think that's obvious. But the real question is, do you go in and buy them yet? And I don't see any reason to race into any of these names yet, because we still have so much. The move was so fast that we really need to be focused on whether or not companies can recover, and how long will it take before they know how bad the damage is. So try and keep your powder dry. I think we'll get great opportunities to buy, but I don't think that movie has started yet. So try and stay focused on just keeping your capital to try and hold out for the lows. So thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesday and Friday at 10:30 a.m. Eastern. You can also see the recording on StockCharts TV YouTube page. And when you do that, on this article here in The Anguish is Everywhere, I do have a promotion going on for a membership sale, and I've listed some testimonials in there.